Right, welcome everyone. Welcome for the chapter 12, investing in stocks. We are using McGraw-Hill book 2022 by Kapoor, Daiba Hughes Hart. This is 7 editions focused on personal finance. Okay, again, we are using a book owned by McGraw-Hill. Okay, we have start now. We're gonna about that's about quite good chapters. Here's about 50 slides. So let's go over. There's about 5 learning objectives. Identify, number one, identify the most important features of common and preferred stock. Number two, explain how you can evaluate the stock investment. Number three, analyze the numerous measures that cause the stock or increase or decrease in value. And then number four, describe how stock is bought and sold. Number five, explain the technique used for long-term investors and short-term speculators. All right, let's look at the objective number one, common stock and preferred stock. Mainly, investors face two concerns when they begin investment program. Okay, this is what I've done in the past when I was in Far East Asia, Southeast Asia to be exact. I was a stockbroker for a number of company investment analysts as well, from Nomura Securities, Morgan Grenfell, Sigma Batara, as well as M Steel Securities, doing mostly common and preferred stock as well as bonds. Okay, there are two concerns again here. Number one is they don't know where to get information they need to get the value potential investments. Number two, they sometimes worry that they won't know what the information mean when they do find it. The common sense goes a long way when evaluating potential investment, which is an increase in sales revenue, sales design for a corporation. Okay, instead it will be yes. So the firm profit increase or decrease over time must be yes, increase. That's the key part. Why invest in stock? For almost 100 years, stock have returned an average return of little less than 10% per year, well above the nation inflation rate. Investor who want larger return, you can choose stocks. Remember, there are three facts here. Number one, well, almost 10% of the average annual return of stock investment in interesting. Keep in mind that the value of stock can also decrease. There's also a risk when you can invest in stock. The key to success with an investment program is often allowing your investment to work for you over a long period of time, and stock are no exceptions. What is common stock? Why is corporation issue common stock? Common stock is the most basic form of ownership for corporations. Corporate managers prefer selling common stock as a method of financing for several reasons. Stock is an equity financing. Money obtained from equity financing doesn't have to be repaid, and the company doesn't have to buy back shares from the stockholders. Dividends are paid out on profits. They are not mandatory. Corporations are required to have an annual meeting at which stockholders have the right to vote and either person or by proxy. Stockholders elect the corporation board of directors and must approve major changes in the corporate policies. Why investors purchase common stock? First is income from dividends. Corporation board members are under no legal obligation to pay dividends. If the board declares a cash dividend, each common stockholder receives an equal amount of per shares. Most companies pay dividends on regular quarterly basis. There's a recorded as well. It's the date on which a stockholder must be registered on the corporation book in order to receive dividend payments. There's a dollar appreciation of the stock value. The stock price may change if a potential investor or current stockholders receive information about the firm of its future prospects. What happens when you have a split of stock? What is stock split? This happens many times in a company like Apple and Google's. Okay, the stock split is to procedure in which the share of stock owned by individuals are divided into a larger number of shares. Most common stock splits are 2-for-1, okay, 3-for-1, or 4-for-1. This is for one. You have one share become 4, one share become 3, one share become 2. Example: if the company got 2-for-1 stock split, the stockholder who had previously 100 own shares now own 200 shares after the split. That's the logic. Okay. Why do corporations split their stock? Management often has the idea price range of the firm stock, then the price per share per has risen above the ideal range. Stock splits occurs bring the stock price project back in line. For example, if the stock price become like say $1,000, becomes so expensive and nobody can afford it, the regular investor can afford it, then they're going to split into 4. For example, 4-for-1. Okay, that's the idea. To make sure everybody, the new investor can come in and buy shares. That's the idea. Decision to stock with a resulting lower price may make the stock more attractive to the investing public. That's the key part. That's why I've been mentioned this earlier. What is preferred stock? Preferred stock is a type of stock that gives the owner the advantage of receiving cash dividend before common stockholders are paid any dividends. Dollar amount of dividends or preferred stock is known before the stock is purchased. Referred to as middle investment because they represent an investment midway between common stock and corporate bonds. Compare the corporate bonds, yield on preferred stock often higher, but preferred stock is often less secure. Compared to common stock, preferred stock are safer investments that offer more secure dividends. Compared to the sale of common stock, issuance of preferred stock is used less often by the fewer firms. In evaluating stock issue, many people, objective number two, many people purchase investment without doing any research, but it's important to evaluate the corporation using the stock and industry in which it operates. Keep in mind the nations, even the world economy and big pictures may impact on the way corporate values and cause the corporate stock to decrease in values. Another factor to consider when valuing stock is the amount of risk that you are comfortable with. There's a systemic risk occur because of the over risk in the market and the economy, while systemic risk affect a specific company or specific industry. Classifying stock investments. Type of stocks such as blue chips, cyclical, defensive, growth, income, large cap, and micro cap. What is blue chip? A stock that is issued to large stable corporations, usually like this. Often history, paying dividend has generally attract conservative investors. What is cyclical? A stock that follows a business cycle of advances and declines in the economy. What is defensive stock? A stock that remains stable during the declines in the economy. For example, healthcare, that's one of this area. Food, that's one of this area. Growth, a stock issued by a corporation that has a potential of increasing sales revenue and earnings profit above the average of all firms in the economy. Income, an investment that pays regular and often higher than average dividends. Large cap, a stock that is issued by a corporation and has a large amount of capitalization in excess of 10 billion. Micro cap, a stock that is issued by a company that has capital within 50 to 300 millions. Okay? This well is available to stock investor and logical place to start evaluation process of the stock with the classes of different type of stock investment described in the exhibit 12.3. Okay? Another one, mid cap, penny and small cap. What is mid cap? Mid cap is a stock that is issued by a corporation that has a capitalization between 2 billion and 10 billions. Penny is a stock that typically trades of less than $5 per share and has a small amount of capitalizations. Penny is a small cap, a stock that is issued by a company that has capitalization between 300 million to 2 billion. Okay? The internet, most corporations have websites and the information that cities provide is especially useful. It is easily accessible, may be more up-to-date and true than printed material obtained from quotient or outside sources. Internet search engine, for example, Google, Yahoo, and others. Personal website, example, Motley Fool, Kiplinger, and Balances. Financial news will be, for example, here, The Street, The Market Watch, MSN Money, CNN Business. This is an example of the internet. Portion opening page from the finance website in the Walmart. This is example in Yahoo. Okay, exhibit 12.4. Okay, the idea of the stock. Which it looks at a portion of summary page from Yahoo Finance and Walmart to the current price. Okay. Stock advisory service also available. Information provided by stock advisory service ranges from simple alphabetical listing to detailed financial reports. While some information is free and the more detailed online, information is often provided for a charge. Three most widely used services will be Value Line, Morningstar, and Zacks. Okay. Newspaper coverage and corporate news. While some newspapers have limited the amount of financial coverage they offer, the Wall Street Journal and most of the newspapers still contains information about the stock. Most people like me, when I grew up, I used Wall Street Journal. This is what I used when I grew up in the 80s, and it has always been the case so far. Typically, information by the newspaper include the name of the company, stock symbol, current information, and then change from one day to the next. For the government requires corporations selling new issue of security to disclose information. SEC website supply information for a corporation that has reported to the federal government. Many periodicals contain information about the stock investing. This is an example here, a Value Line report for the Microsoft corporations. Objective number 12.3, numerical measure that influence investment decisions. How do you determine whether the time is right to buy or sell the stock? The key is the timing. You know, you always want to buy low and sell high, not the other way around. No, don't buy high, sell low. It's going to go bankrupt. Okay? Corporate earnings are the most important significant factors that account for increase or decrease in the value of a stock. Higher earnings equate a higher stock price, and reverse is also true. The EPS, which is earning per shares, are corporate earnings divided by number of outstanding shares of a firm common stock. Measure of company profitability. As a increased EPS, a healthy sign. P ratio. This is standard I use when we do valuation. What is this? It is the price of the shares of stock dividend by corporation EPS stock. The higher the P is, the more expensive it becomes. Okay. Give investors an idea how much they are paying for the company earning power. The higher the P ratio, the more they are paying for the earnings. Stock with high PE also indicate investor optimism because they often expect higher earnings in the future. Lower PE indicates have lower earning expectation of the company stock. Average PE ratio in the market is between 15 to 25 times, which is the projected earning of the estimated future earnings. Okay. Number 19, example here, EPS and PE ratio. Example, General Mills, it has an earning 1.73 million, or 1,753 million. It has 605 common shares. The earning per share will be 290. How are you going to calculate? Earnings 1,753 million divided by 605 million, which is 2.90. Earning per share is equal to earnings divided number of shares outstanding. Example of P ratio again here. Ultra Beauty common stock is selling at 296 a share. Ultra Beauty earnings per share is 11%. The corporate price earning ratio is 27. So the logic will be P ratio will be price per share divided by earning per share. 296 by 11 equal to 27. Dividend yield and total return. Dividend yield is the annual dividend amount divided by the stock current price per share. Increase in dividend yield is the healthy sign for any common any stock investment. To dividend yield is useful. You should also consider whether the stock price per share is increasing or decreasing in dollar value. Total return is the calculation that increase the yield dividend amount as well as an increase or decrease in original purchase price of the investment. Example, dividend yield, total return. Example, here is the example. Dividend yield, which is Walmart, a share of stock, Walmart stock pays a dividend of $2.16, and current selling as $125.30. The current yield will be 1.72%. How do you do that? Dividend yield equal to annual dividend amount, which is $2.16, divided by current price of shares, which is 125.30. That will give you a 1.72%. Example of total return the other way is for PepsiCo here given to you. Assume you own 100 shares of stock. PepsiCo then purchase at 113 a share and hold your stock for 1 year before selling it at 140 per share. The increased value will be 3,000. The total income will be 380. So you're gonna get the return 380. So how are you gonna do that? Total return equal to dividends plus capital gain. 380 plus 3,000. That's you got 380. Okay, let's continue, move on. Let me just grab a water here. The next one we discuss is beta and book value. What is beta? Beta is a measure that compares the volatility associated with a specific stock issue with the volatility of the stock market or index. Market beta is 1.0, meaning the most common have betas that range between 0.5 and 2.0. The conservative stock tend to have low betas, while the more specific stock have greater beta than 1. Most beta are positive, but it's possible for beta to be negative. Okay. What is book value? Book value is a share of stock is determined by deducting all liability from corporate assets and dividing the remainder by a number of outstanding shares of common stock. The book value calculation may be misleading because the dollar amount of the asset used in the firm may be understanding and overstated on the firm financial statement. Example beta and book value. Example here, beta calculation Sony. Example Sony here. Assume the stock market increased by 10% and Sony has a beta of 1.4. Based on the case below, Sony stock will increase by 14% when the market increases by 10%. So increase of all 10% times 1.4 will be 14%. This is example beta going into Sony. An example Southwest Airline 22 asset 26 to 43 million. In terms of asset, liability 16,390 million. It has issued 570 million stock, so the book value will be 17.20%. How are you going to calculate? Book value equal to asset minus liability divided by number of shares outstanding. So you got the 17.2%. Okay, 26 you get from here, 16 you get it from here, 57 you get it from here. So that's how you get the number. Other factors that affect price of a stock. There are two other factors that affect the stock. Is the predicting future value of a share. Stock is practical example of time value of money concept. Always remember that the price of a share of stock is determined by the number of investors is willing to pay for it. Price that a successful investor is willing to pay for shares of stock is determined by amount of dividend you expect to receive in the future, or potential increase in the price of share of stock, or combination of future dividend and potential increase in the price of the stock. Making a decision to buy, hold, or sell stock. Use the following suggestions regarding individual stocks, such as evaluate investment, access the professional advice service, analyze the firm finances, track the firm's product line, monitor economic developments, and be patient. Buying and selling stock. Number 4. In the primary market, you purchase financial security via investment bank or other representative from the issuer and those securities. Investment bank is a financial that assists corporation in raising funds, usually by helping to sell new security issues. New securities sold through investment bank can be issued by corporations that have sold stock and securities before, need of selling it, or they can be initial IPOs. Secondary market is a market for existing financial securities that are currently traded among the investors. Remember, this is the things that I've done in the past. When I was working on Nomura, we raised about $2 billion of IPO from the Indonesian capital market. Most of them invested from Japan as well as in New York. Secondary market for stocks. Security exchange is a marketplace where a number of brokers represent investors meet to buy and sell the securities. The NYSE is one of the largest security exchanges in the world. Most members of NYSE represent brokerage firms. Other members are called specialists and buy and sell a particular stock to maintain fair and orderly market. The OTC market is a network of dealers who buy and sell stock. Corporations that are not listed on the Securities Stock Exchange. Most of these securities are traded through NASDAQ, an electronic marketplace for the stock. When you purchase a stock, it's called the secondary market. When the transaction is completed on the Securities Exchange and through the over-the-counter market, such as the OTC. Okay. Brokerage firms and account executive. Account executive is a stockbroker. This is what I've done in the past. You have to be a licensed individual who work for the brokerage firm and buy and sell securities for the client. You should have already determined your financial objective before choosing an account executive. You must be careful also to communicate those objectives to the account executive. You should also be actively involved in the decision related to your investment program, and you should never allow your account executive to use his or her discretion without your approval. Keep in mind, your account executives are not liable for the client losses and that result from their recommendations. There are two types of brokerage firms. One is full service, the other one is discount. What is full service? Investor with little or no expense, usually individuals who are comfortable making investment decisions, who are comfortable trading stock line. This is full service. Discount mostly people who have understand and have done research and prefer to make their own decisions. Individuals who are comfortable trading stock are online. Again, factor to consider in choosing between full service and discount brokers. What is that? Commissions, informations, and investment decisions, and how easy to buy other securities. These are the questions that being asked. Okay, and then sample stock transaction. What are they? Example is market order. It's required to buy or sell stock at the best available price. Payment is generally required within 2 business days after the transactions. Limit order is a request to buy and sell stock at specific price. When you purchase limit order, ensure that you will buy a limit at the limited price or lower. When you sell a limit order, ensure that you will sell a limit price at higher. Stop loss order is an order to sell particular stock at a market available after the market price reaches a specific amount. What are the commission charges? Most brokers charge a minimum commission between $5 to $25 or buying and selling stocks. Additional commission charge may be based on the number of shares and the value of stock bought and sold. Generally, full brokerage firms charge higher commissions than those charged by the discount rate brokerage firms. Okay, full brokerage firm may charge 1%. Okay, that's the idea. Remember, according to full brokers do not spend a lot of time with investors that have only small amount to invest. Remember that. Most of the full brokerage firm cater to high net worth individuals. Strategy number 5. Okay. Long-term techniques include the following. Buy and hold techniques, which is calculated by purchasing the stock and holding it for several years. Investment can increase in value through dividends or the price of the stock increasing. Number 2, dollar cost averaging. It's a technique used by investors who purchase an equal dollar amount of the same stock or equal interval. Goal administering the average cost per share and avoid the common pitfall of buying and high and selling low. Number 3, the investment plan. Allowed to purchase stock directly from a corporation without having to use an account executive or brokerage firm, while dividend reinvestment plan allow you to use the option to reinvest your cash or dividend to purchase stock of the corporations. Okay, this is an example of the cost averaging for Johnson & Johnson's investment 2014, stock price 95. You got $21. You got every time you got you purchase every year here. 2,000 shares, $2,000 investment, stock price will vary. So you tally up, total will be 14,000 for 7 years, divide number of shares. So this is the average. So this is your cost average 118.74. That's the idea. Average it out. Short-term investment strategies. Number 1, buying stock on margin is a speculative technique whereby investor borrow part of money needed to buy 5 years stock. The current margin is about 50%, which means you borrow up to half of the stock price, purchase price. You face the possibility of larger loss because you own more shares, and you must also pay interest on money borrowed to purchase stock margin. Selling short is a sell stock that has been borrowed money from a brokerage firm and must be replaced later. That's okay. If you sell short, that the price goes up, then you are going to be out of money. Then you have to you're going to get lost. Okay. Number 3, trading in options. Example, call option and put options. What are they? Options give you the right, but not the obligation to buy or sell a stock at the premium price during a specific period. Remember, the methods presented in this section are high risk and speculative. Do not use them unless you fully understand the underlying risk. Also, you should not use them until you have experienced success using the more traditional long-term techniques described previously. That's the key. Okay, these are the things. Selling short, an example here given to you. You think GM stock is over at $35 per share, your stock will decrease over the next 4 years to 6 months. You call your broker to arrange borrow $100 shares of GM stock. The broker sells you borrow stock at the market $35. And GM 4 months later, the GM stock drop at 27 shares. You start to purchase 100 shares of GM stock at current overprice. So that's basically you make about $8 per share. The new purchase stock is given to brokerage firm and repay the borrowed stock. That's the example of selling short. So in this case, example selling short, general profit. Actually, handled because the price declined 35 to 27. So 35 selling price, 35 times 100 shares. You buy again 27 times 100 minus 27, you make up $100 price by selling share. Okay, that's actually an example of the selling short strategies. That's basically conclude the chapter. Let's do a chapter summary. Basically, number 1, summary is identify the most important features of common stock and result. So these are the form of equity that you have to done. Okay, and then identify. Number 1, that's done. I think that's done already. Okay, number 2, again, continue with number 1. Invest stock because they want a larger return, because stock generally provide higher returns. Okay, it includes dividends, income appreciation value, and possibility of gain through stock split. And in common stock, few companies may issue preferred stock. The most important is to explain priority investor preferred stock, enjoy the receiving cash dividend before any cash dividend are paid to common stock. So preferred stock has the priority over the dividends. Okay. Chapter 12, objective number 2, explain how you can evaluate stock investment. Okay, they've given to you information available here in such services as from Value Line, Morningstar, and ZAG. And newspaper corporation insurance. During my time, I use Wall Street Journal. That's the most reliable, or Bloomberg. Number 3.3, analyze the numerical measures that cause a stock to increase or decrease in values. Okay. The higher the earning, the higher stock price. Lower earning means equal to lower stock price. It's based on the EPS, earning per shares. Okay. Okay, again, analyze the object number 3, analyze the numerical value, means the cost of stock is decreased. In order to have a stock price, you can use dividend yield, total return, beta, and book value. Okay, that's a key part. This is the way you calculate dividend yield, total return, beta, or book value. Objective number 4, describe how stocks are bought to be sold. Mostly people buying at secondary market. There's also an IPO offering. That also transaction can be done through full securities, brokerage firm, or discount brokerage firm. And you can also trade online using a traditional trading techniques. You can buy and sell depending on the stock that you choose. There's also commissions on the stock transaction. Other brokerages do charge minimum commission as well. It is charged based on the number of value and stock that bought and sold. A full service brokerage firm charges higher commission than discount brokerage firm, usually about 1%. Number 5, explain the trading technique used by long-term investor and short-term investor. For long-term investors, usually buy and hold strategies for at least a year or longer. For speculators, usually buy and trade a shorter time. So this is a traditional technique. For investors will be buy and hold techniques, dollar cost averaging, the investment plan, and dividend reinvestment. This is the long-term investor. For the short-term one, usually margin, selling short, and trading in options. So that's basically conclude this particular chapter. I will upload it on YouTube as well as a puzzle for your interactive learning. Thank you, everyone. Bye-bye.